All right, let's talk about two investing strategies people love to overthink: dollar cost averaging versus lump sum investing. One's the careful tiptoe your way in method. The other is cannonball into the pool move. And as usual, everyone online has a strong opinion and zero chill. But here's the truth. Both work, both have benefits, but one statistically slaps harder. Let's break it down. So you've got some cash. Maybe it's a tax return, an inheritance, a work bonus, or you won the lottery. Good for you. Now what? Dollar cost averaging, or DCA, if you're a cool kid, means you take that money and spread it out over time. Let's say you've got $12,000. Instead of dumping it all into the market today, you invest $1,000 a month for a year. That way, if the market drops, you're buying in cheaper next month. And if it goes up, well, at least you got in last month. It's like dating slowly instead of marrying someone after 3 drinks and a good Spotify playlist. Safer, smoother, less likely to end in regret. The benefit? Peace of mind. Dollar cost averaging protects you from the gut punch of investing a lump sum the night before a market crash. It's easier on your mental health, especially for the type who refreshes their portfolio more often than their toothbrush. It gives you a plan, it feels disciplined, and for many people, it's how they invest their paycheck anyway. Every month, like clockwork. It turns investing into a habit, not a panic attack. But let's talk lump sum investing. This is all in right now strategy. Got $12,000? You drop that sucker into the market today. No hesitation, no second guessing, just vibes and data. And guess what? Statistically, lump sum wins, like a lot. Vanguard, Fidelity, Morningstar, all these fun finance nerds have done studies that show investing in lump sum beats dollar cost average about 66% of the time. Why? Because over the long run, the market tends to go up. The longer your money is in the market, the more time it has to grow, compound, and make sweet love to your future retirement account. Holding money on the sidelines while your DCA means you're missing out on potential gains. Here's the catch. Lump sum only works if you've got the stomach for it. If you dump your cash and the market drops 10% next week, can you hold? Are you going to panic sell, into your ramen and never invest again? Because if you flinch, if you sell low after buying high, you're cooked. Emotionally, financially, spiritually cooked. This is where dollar cost averaging saves your ass. It smooths the ride. It keeps you from making dumb mistakes because it's built on discipline, not timing. So what should you do? Well, if you've got a big chunk of cash and you're confident in your ability to stay calm, lump sum it. Statistically, you come out ahead more often than not. But if you're anxious, if the market feels like a roller coaster and you hate roller coasters, or if you're the type to yell, I'm out at the first sign of a red candle, then DCA might be your safer bet. Because the best investing strategy isn't one with the highest returns on paper. It's the one you'll actually stick with without losing sleep or throwing your laptop across the room. Now, if we're talking about investing over time, like your paycheck each month, then DCA is literally the only option. You don't have a lump sum. You've got little piles showing up every month. That's great. Keep it up. Just automate it and forget about it. DCA isn't useless. In fact, if you've got a regular paycheck and you're not sitting on a Scrooge McDuck pile of cash, DCA is your best friend. Here's why. You're earning money month to month. You don't have a lump sum, so what do? You automate. You set up an automatic investment, say $500 from each paycheck, and it goes straight into your index fund, ETF, whatever you've chosen. No thinking, no fiddling with charts, no waiting for the right moment that never comes. You're buying the market whether it's up, down, or sideways. Sometimes you buy high, sometimes you buy low. Over time, you get the average. And guess what? The average is pretty damn good. It removes emotion. No more panic selling when CNBC starts screaming about recessions. No more waiting for that dip that never dips. You just invest like a boring, consistent adult, which is weirdly the most powerful financial move you can make. And it's brainless in the best way possible. Automation means it happens before you have a chance to blow that $500 on patio beers, dumb gadgets, or whatever new self-care scam Instagram is selling this week. It's pay yourself first in action. It also builds a killer habit, the kind of habit that turns a six-figure portfolio without you really noticing. You just keep living your life while your money quietly gets jacked in the background. So yeah, if you're working, DCA is the move. It's slow, steady, wildly effective. It's a tortoise that keeps lapping the guy who keeps waiting for a sure thing. And the best part, you don't have to think about it. You just click a button once, set the automation, and boom, you're investing more consistently than half the finance bros who spend their weekends reading candlestick charts and still end up broke. Let them trade. You'll be chilling with a fat portfolio and a lot less stress. Let's do a real quick example because numbers make this more fun. Say you invested $10,000 all at once into the S&P 500 index fund. Average return over time about 10% a year. After 30 years, that's about $174,000 if you leave it alone and don't touch it, panic, or try to beat the market. Now let's say you DCA that $10,000 over the next 12 months, roughly $833 a month. If the market rises steadily, your returns will be lower than lump sum. If the market dips and then recovers, DCA might do better, but statistically, lump sum wins more often. You know what doesn't win? Leaving your money in a savings account making 1.5% while inflation kicks you in the crotch. Here's the real trick. Don't overthink this. You're not a hedge fund. You don't need to optimize for every decimal point of return. What you need is consistency, long-term thinking, and to avoid doing dumb shit like selling in a panic or YOLOing into crypto because some guy on TikTok looked confident. So lump sum or DCA. If your cash is ready and you've got nerves of steel, lump sum. If your nerves are made of damp spaghetti, DCA. Either way, get that money in the market, let it work for you, let it grow while you do absolutely nothing, because that's the secret. The market rewards patience, not perfection. Pick your style, stick with it, and don't let analysis paralysis keep you broke. Now go invest so you can come out here on a Wednesday afternoon and do a beautiful hike without the crowds. And subscribe for more.